Hey, it's tax time again. Today we're talking about Roth conversions and why they're effective. But first, a little background. So you might have seen these before. This is what we call the tax triangle. So there's three kinds of taxation, mainly three types. One would be tax deferred. So that would be your assets in retirement accounts. When you take money out, it's taxed at ordinary income rates. That's the highest of rates. One would be tax-free. We like tax-free. That would be like a Roth IRA. You take money out of a Roth, you pay no tax. Third one is taxable. These are assets outside of a retirement account. So if you hold an asset outside of a retirement account for at least a year and a day and you sell it, you get a special capital gains rate. And that capital gains rate is anywhere between 0% and 20% based upon your income level. So here's the strategy. A lot of you have a lot of your wealth in tax deferred. You've been saving into your 401k or your 403b or your IRA, wherever it may be. That's great. That's going to help you retire. But here's the problem. The problem is all this money here keeps growing and growing and growing and comes out, when you take the money out, is taxed at ordinary income rates. Here's the solution. The solution is to start taking money out of here, put it directly up into a Roth IRA in the tax-free. That's called a Roth conversion. There's no limits on a conversion. It's confusing. A lot of people think there's limits. Anyone can convert, any age. You can be 20 or 80. It doesn't matter what age you are, right? You can convert any amount, $5, 100,000, whatever the amount is. You can convert any amount you want, right? And you don't have to be working, retired, not working. You can do Roth conversions in any case. So even though you can do them, should you? Well, now you got to look at your tax brackets. And here's the way the tax brackets work. They have graduated rates. Like there's a 10% bracket, 12%, 22, and 24. Actually goes high as 37% right now. So what you might want to do is look and see what bracket you're in. In this example, let's say you're in the 22% bracket. Maybe you want to do enough Roth conversion here, convert up there, to get to the top of the 22% bracket. You have to do a little analysis. You got to figure out, well, what tax bracket am I going to be in retirement? What tax bracket am I in right now? You want to fill up lower brackets. When you fill up lower brackets, then you get more money up here, and now you can manage your retirement better. When you're retired, you take some money out of here, you fill up those ordinary income brackets, the low ones. You take some out of here, well, that's capital gain rates, which is taxed at the highest rate, 20%. And then you take some out of here, it's tax-free. That's what we call income diversification when it relates to retirement. If you got money in all three pools, you'll be able to pay a lot less taxes in retirement. And guess what? You'll be able to go on more trips and have more fun. That is today's tip. At Pure Financial, we have advisors that are ready to talk to you about taxes, and I love to talk about taxes, and so do they, but we all hate to pay taxes. That's why we have a free tax reduction analysis, and you can schedule your appointment right online.